the calculation and interpretation of a financial ratio. In the complex world of finance, where numbers are the key to understanding a company's health, financial ratios come into play on the fringes. These ratios are essentially mathematical formulas that reveal rich insights into a company's performance, and help investors and decision-makers navigate the complexities of financial data. Financial ratios are like X-rays of a company, revealing underlying strengths, weaknesses, and overall health. In this blog, we unpack the importance of financial ratios and present key ratios with real-world examples. Why financial ratios matter. Financial ratios are a powerful tool for anyone involved in financial decision-making. Whether you are an investor, manager, or business owner, these ratios provide a snapshot of a company's financial health. By examining the relationships among various financial elements, ratios provide valuable insight into profitability, liquidity, efficiency, and solvency. In short, ratios help answer important questions such as, is the company profitable, and, can the company meet its short-term obligations? The ability to interpret these ratios gives individuals the knowledge they need to make strategic decisions that affect the bottom line. Let's now delve into some key financial ratios. Each ratio sheds light on a specific aspect of a company's financial performance. Profitability ratios. Gross profitability ratio. Formula: gross profit to net sales, x 100. Example: a company with gross profit of $500,000 and sales of $1 million has a gross margin of 50%. Net profit margin. Formula: net profit to net sales, x 100. Example: if a business generates a net profit of $200,000 on revenues of $800,000, the net profit margin would be 25%. Liquidity ratio. Current ratio. Formula: current assets are current liabilities. Example: a company with current assets of $600,000 and current liabilities of $300,000 has a current ratio of 2. Liquid ratio. Formula: current assets, inventories, current liabilities. Example: if a company has current assets of $500,000, inventories of $100,000, and current liabilities of $200,000, the current ratio is 2. Efficiency ratios. Inventory turnover ratio. Formula: cost of sales divided by average inventory. Example: if cost of sales is $1 million and average inventory is $200,000, the inventory turnover ratio is 5. Days sales outstanding, DSO. Formula: accounts receivable to total credit sales, * number of days. Example: if accounts receivable of $50,000, total credit sales of $500,000, and collection period of 30 days, DSO is 6 days. Inventory turnover ratio. Formula: cost of sales average inventory. Example: if a company's cost of sales is $500,000 and average inventory is $100,000, inventory turnover is 5. Accounts receivable turnover. Formula: net sales average accounts receivable. Example: if net credit sales are $800,000 and average accounts receivable are $200,000, the accounts receivable turnover ratio is 4. Solvency ratios. Debt to equity ratio. Formula: liabilities shareholders' equity. Example: if a company has liabilities of $800,000 and shareholders' equity of $1,200,000, the debt-to-equity ratio would be 0.67. Interest coverage ratio. Formula: earnings before interest and taxes, EBIT, interest expense. Example: if EBIT is $500,000 and interest expense is $100,000, the interest coverage ratio is 5. Market ratio. Price-to-earnings ratio, PER. Formula: market price per share earnings per share, EPS. Example: if the market price per share is $40 and EPS is $4, the PER is 10. Dividend yield. Formula: dividend per share divided by market price per share. Example: if a company pays a dividend of $2 per share and the market price per share is $50, the dividend yield is 4%. Current ratio. Formula: current assets are current liabilities. Example: current assets of $800,000 and current liabilities of $400,000 would result in a current ratio of 2. Quick ratio, acid test ratio. Formula: current assets, inventories, current liabilities. Example: if current assets excluding inventory are $600,000 and current liabilities are $200,000, the quick ratio is 3. Profitability ratio. Net profit margin. Formula: net profit to net sales, x 100. Example: if net income is $150,000 on sales of $1 million, the net profit margin is 15%. Return on equity, ROE. Formula: net income average shareholders' equity. Example: if net income is $200,000 and average shareholders' equity is $1 million, ROE is 20%. Conclusion. These ratios are just the tip of the iceberg, and mastering their interpretation will enable you to make informed decisions in the dynamic world of finance. There are many other ratios that provide a comprehensive view of a company's financial health. The key is to use a combination of ratios to gain a comprehensive understanding of the various aspects of performance and risk.